dear friends. In today's lecture we will see role of monetary policy. Introduction. Monetary policy is concerned with the measures taken to regulate the supply of money, the cost and the availability of credit in the economy. In developed countries, the monetary policy has been usefully used for overcoming depression and inflation as a cyclical policy. Monetary policy is a major instrument which will help to achieve macroeconomic objectives. Central Bank of country formulates and implements the monetary policy in a country. Monetary policy is concerned with the control of money supply in the market and the rate of interest for stabilizing the economy at full employment level. Or in simple words, at the times of recession, monetary policy involves the adoption of monetary tools which tend to increase the money supply and lower the interest rates so as to stimulate aggregate demand in economy. In other words, of this round, the monetary policy is defined as discretionary act undertaken by the authorities designed to influence first the supply of money, second the cost of money or rate of interest, and third one is the availability of money for achieving specific objectives. It is important to understand the distinction between the objectives or goals, targets and instruments of monetary policy. We shall first explain as the objectives or goals of monetary policy in a developing economy adopted by the Reserve Bank of India. Objectives of monetary policy. According to RBI Governor Dr. D. Subbarao, the objectives of monetary policy in India are price stability and growth. These are pursued through ensuring credit availability with stability in the external value or rupee and overall financial stability. These are the main objectives of monetary policy in the context of developing countries. First, to regulate money supply in the economy. Money supply includes both money in circulation and credit creation by banks. Monetary policy is framed to regulate the money supply in the economy by credit expansion or credit contraction. By credit expansion means giving more loans, the money supply can be expanded. By credit contraction means giving less loans, money supply can be decreased. The main aim of the monetary policy of the Reserve Bank of India wants to control the money supply in such a manner as to expand it to meet the needs of economic growth and the same in the contract it to curb inflation. In other words, monetary policy aimed at expanding and contracting money supply according to the needs of the economy. Second one, to attain the price stability. Another major objective of monetary policy in India is to maintain the price stability in the country. It implies control over inflation. Price level is affected by money supply. Monetary policy regulates money supply to maintain price stability. Third one, to promote economic growth. Now, an important objective of monetary policy is to make available the necessary supply of money and credit for the economy, growth of the economy. Those sectors which are quite significant for economic growth are provided with adequate availability of credit. Fourth one, to promote saving and investment. By regulating the rate of interest and checking inflation, monetary policy promotes saving and investment. Higher the rate of interest promotes saving and investment. Fifth one, to control business cycles. Boom and depression are the main phases of the business cycle. Monetary policy puts a check on boom and depression. In periods of boom, credit is contracted so as to reduce money supply and thus check inflation. In periods of depression, credit is expanded so as to increase money supply and thus promote aggregate demand in the economy. The instruments of monetary policy are of two types. First one is quantitative, or we can say that generally indirect measures of the monetary policy. First one is CRR, SLR, open market operations, bank rate, repo rate, reverse repo rate. Second is the qualitative measures. In that we can say that the selective or direct measures, change in the margin money, direct action and moral suasion. These both methods affect the level of aggregate demand through the supply of money, cost of money and availability of credit. Of the two types of instruments, the first category includes bank rate variations, open market operations and changing reserve requirements, cash reserve ratio, statutory reserve ratio. Policy instruments are meant to regulate the overall level of credit in the economy through commercial banks. The selective credit controls aim at controlling specific types of credit. They include changing margin requirements and regulation of consumer credit. Whereas, in times of recession or depression, expansionary monetary policy or easy money policy is adopted, which increases aggregate demand and thus stimulates the economy. On the contrary, in times of inflation, contractionary monetary policy or tight money policy is adopted to control inflation and achieve price stability. Both policies discussed as expansionary monetary policy. When the economy is faced with recession or involuntary cyclical unemployment which comes about due to fall in aggregate demand, the central bank intervenes to cure such situation. Central bank takes steps to expand the money supply in economy and lower the rate of interest with a view to increase the aggregate demand, which will help in stimulating the economy. First, open market operations. The central bank undertakes open market operations and buys securities in the open market. Buying of securities by the central bank from the public, chiefly from commercial banks, will lead to increase in reserves of the banks or amount of currency with the general public. With greater reserves, commercial banks can issue more credit to investors and businessmen for undertaking more investment. Second one is the bank rate. The central bank lowers the bank rate, which is the rate of interest charged by the central bank of a country on its loans to commercial banks. At a lower bank rate, the commercial banks will be induced to borrow more from the central bank and will be able to issue more credit at the lower rate of interest to businessmen and investors. This will not only make credit cheaper but also increase the availability of credit or money supply in the economy. Third one, changes in reserve ratios. The central bank may reduce the cash reserve ratio, that is the CRR, to be kept by the commercial banks. In countries like India, this is a more effective and direct way of expanding credit and increasing money supply in the economy by the central bank. With lower reserve requirements, a large amount of funds is released for providing loans to businessmen and investors. As a result, credit expands and investment increases in the economy, which has an expansionary effect on output and employment. Similar to cash reserve ratio, in India there is another monetary instrument called as a statutory liquidity ratio, nothing but SLR, used by the Reserve Bank to change the lending capacity and therefore credit availability in the economy. To increase the lendable resources of the banks, Reserve Bank can lower the statutory liquidity ratio. It may be noted that the use of all the tools of monetary policy leads to an increase in reserves or liquid resources with the banks. Fourth one, selective credit controls. Selective credit controls are used to influence specific types of credit for particular purposes. They usually take the form of changing margin requirements to control speculative activities within the economy. When there is a brisk speculative activity in the economy or in particular sectors in certain commodities and prices start rising, the central bank raises the margin requirement or them. Fifth, change in margin money. The result is that the borrowers are given less money in loans against specified securities. In case of recession in a particular sector, the central bank encourages borrowing by lowering margin requirements. Sixth one, moral suasion. Under this method, RBI urges commercial banks to help in controlling the supply of money in the economy. Tight monetary policy to control inflation. Now, what is tight monetary policy? Tight or contractionary monetary policy is a course of action undertaken by the bank such as the Federal Reserve to slow down economic growth, to constrict spending in an economy that is seen to be accelerating too quickly, or to curb inflation when it is rising too fast. The central bank tightens the policy or makes money tight by raising short-term interest rates through policy changes to the discount rate and federal funds rate. Boosting interest rates increase the cost of borrowing and effectively reduces the attractiveness. Tight monetary policy can also be implemented via selling assets on the central bank's balance sheet to the market through open market operations. Tight monetary policy is different from but can be coordinated with a tight fiscal policy which is enacted by legislative bodies and includes raising taxes or decreasing government spending. When the Fed lowers rates and makes the environment easier to borrow, it is called monetary easing. A benefit of tight monetary policy. Open market treasury sales. In a tightening monetary policy environment, the Fed can also sell treasuries on the open market in order to absorb some extra capital during a tightened monetary policy environment. This effectively takes capital out of the open market as the Fed takes in funds from the sale with the promises of paying the amount back with interest. In a tightening monetary policy environment, a reduction in the money supply is a factor that can significantly help to slow or keep the domestic currency from inflation. The Fed often looks at a tightening monetary policy during times of strong economic growth. An easing monetary policy environment serves the opposite purpose. In an easing policy environment, the central bank lowers rate of stimulate growth in economy. Lower rates lead to consumers to borrow more, also effectively increasing the money supply. Many global economies have lowered their federal funds rates to zero, and some global economies are in negative rate of environments. Both zero and negative rate environments benefit the economy through easier borrowing. In an extreme negative rate environment, borrowers even receive interest payments, which can create a significant demand for credit. What are the three main monetary tools of the Federal Reserve? These are the Federal Reserve's three primary monetary tools are reserve requirements, the discount rate and open market operations. The reserve requirements stipulates the amount of reserves that member banks must have on hand. The discount rate is the rate at which banks can borrow from the Federal Reserve, and open market operation is the Fed buying or selling of US treasuries. Role of monetary policy for promoting economic growth. Economic growth implies the expansion in productive capacity or capital stock in the economy, so that increase in real national output or income attained. As is well known, economic growth can be speeded up by accelerating the rate of savings and investment in the economy. This requires the first adjustment between demand for and supply of money. The monetary policy plays key role in the development of underdeveloped countries by controlling price fluctuations and general economic activities. This is done by making proper adjustment between demand for money and the supply of money. As the economy develops, there is a continuous increase in demand for money. So, central authority takes measures to increase the money supply proportionate to the increase in demand for money in order to avoid inflation. On the contrary, fall in price level adversely affects the pace of development by bringing downward spiral of prices and output. Under both circumstances, monetary authorities take steps by adopting appropriate monetary policy to control use of money and credit. It also controls speculative activities through direct physical controls. Therefore, monetary authority is conscious of controlling fluctuations in prices so that it may not adversely affect the investment and production in an economy. Second one is the price stability. Generally, underdeveloped countries face the problem of inflationary pressures due to a variety of structural rigidities and imbalances. Inflationary pressures adversely affect the propensity to save and divert investable resources into unproductive channels. Sometimes it has been noticed that inflationary increases leads to frequent devaluation of the domestic currency, and fluctuating exchange rate also creates chaos in the internal trade. Consequently, it applies to the rate of economic growth. So, monetary authority keeps a vigil on the movements of prices and takes steps to control the same accordingly. It also tries to maintain exchange stability. In other words, monetary authority takes qualitative and quantitative methods of credit control to check inflationary trend in the economy and further to gear the process of economic growth. Third one is monetization of the economy. Non-monetized sector is common in many of the underdeveloped economies. In many countries of Africa and Asia, monetization ratio is relatively less. In other words, barter system largely prevails. Monetary policy expands the area of monetization and replaces barter system by monetary exchange system. Fourth one, development of capital market. A developed capital market helps the people to invest their savings directly or indirectly in productive activities. They make direct investment by purchasing themselves shares of public enterprises, or they make indirect investment by investing their saving in the shares of mutual funds. As a result of developed capital market, adequate investment is made in productive activities. Furthermore, proper control over share market by stock exchange reduces the risk element of the people, and they feel encouraged to invest their savings in shares. Enterprises succeed in getting long-term loans on reasonable rate of interest for capital formation from the capital market. In this way, monetary policy plays a significant role in economic development by establishing organized capital market. Fifth one, creation and expansion of financial institutions. In underdeveloped countries, monetary policy can work to accelerate the process of economic development by improving the currency and credit system of the country. For this purpose, more banks and financial institutions should be established to mobilize large resources into the productive channel. Generally, financial institutions are situated in a big cities which provide loan facilities to big industrial concerns, while small and medium businessmen and cultivators are deprived of these facilities. Therefore, it is the dire need of the underdeveloped countries that banking facilities should be extended to rural areas. In the absence of these facilities, village money lender is the last source who charges high interest rates. Therefore, central authority should pay special attention to this problem and take measures to expand financial institutions in the rural and backward areas. In this regard, network of cooperative credit societies with apex banks financed by central bank is useful instrument in providing the credit facilities to rural masses. These institutions can also be helpful to the business and industry to a greater extent. Moreover, central authority can act as a fiscal agent of the government and manage public debt. They can also organize and set up a stock securities market and bill market. Another act is also done by the central bank as of a guardian of the money market. Therefore, according to the Professor Meyer and Baldwin, central banks' control of commercial banks is the chief weapon of monetary policy. Seventh one, the credit control. In order to boost up the economic development, monetary policy comes forward to influence the pattern of investment and production in a country. To control the inflationary forces, it adopts both qualitative and quantitative methods of credit control. But its successes entirely depend on the range of credit institutions found in the country and on forms of credit controls that are employed by the central bank. Unfortunately, in underdeveloped countries, financial institutions are not fully organized and developed. In fact, quantitative measures which include open market operations, bank rate policy and variable reserve ratio are not much successful in less developed countries. At the same time, qualitative methods are, however, more effective in influencing the allocation of credit. So, they should be adopted to change the character and pattern of investment and production by differentiating between the cost and variability of credit to different sectors. But in underdeveloped countries, there is a strong tendency to invest into unproductive channels instead of productive channels. Therefore, this system has a bottleneck of making discrimination between essential and non-essential use of bank credit. Under these circumstances, selective credit controls are more appropriate and suitable for limiting credit facilities for such unproductive purpose. They are useful in controlling the speculative activities and thus beneficial in controlling sectional inflation without affecting the pattern of investment and production adversely. If this is done in a proper manner, it will certainly quicken the pace of economic development in a country. Seventh one, the favorable and suitable interest rate structure. For the purpose of development in an economy, investment on a gigantic scale is the most essential. To some extent, cheap money policy favors as it makes public borrowing easily available at a lower cost, which in turn stimulates investment in private as well as in a public sector. Therefore, a policy of lower rate of interest is recommended as an incentive to economic development. On the contrary, some other economists also argue in favor of high interest rate policy as it restricts borrowings for speculative and undesirable purposes. Thus, it works as an anti-inflationary measure. Moreover, it also secures allocation of resources into most needed productive channel. Monetary authority in such a critical situation plays an active role by adopting suitable interest rate policy, which promotes economic development and retards superfluous spendings in the economy. Eighth, debt management. In underdeveloped countries, the government has to borrow on a large scale to implement the various schemes for economic development. Therefore, monetary authority has the primary aim to manage the public debt effectively. Professor J.D. Sethi, who has said, the emphasis on this objective says debt management is to create conditions in which public borrowing can increase from year to year and on a big scale without giving any jolt to the system. And this must be cheap rate to keep the burden of the debt low. On the basis of this argument, one can say that monetary policy has manifold aims in a developing economy to stimulate economic development. Ninth one, exchange stability. Economic development of underdeveloped countries requires that the balance of payments of the country should either be in equilibrium or favorable. To achieve economic development, the objective of the monetary policy is to attain exchange stability. For the detail of this point, you can refer the academic script. Conclusion. So, it can be concluded that the implementation of the monetary policy plays a very prominent role in the development of a country. It is a kind of a double-edged sword. If money is not available in the market as the requirement of the economy, the investors will suffer, investment will decline in the economy. And on the other hand, if the money is supplied more than its requirement, then the poor section of the country will suffer. I hope you understood all the concepts regarding the monetary policy. Thank you.